Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. I sort of have my voice back today, so bear with me, but we have a very important topic, and that is the potential changes to capital gains and capital gains exemption. So right now, if you have a capital gain on whether it's a sale of a rental property or a stock portfolio or anything that triggers a capital gain, only half of it is taxed. So half of it is added to your income and you're taxed accordingly. Now, moving forward, that will probably change. When, how, what it looks like, we're not quite sure. But what we want to cover in this video is how it could impact you and your financial plan. And at the end of this video, we're going to go through some different scenarios that you might fall into and a lot of our clients will fall into, and just some strategies to work around it, to avoid some of that tax, and maybe some tax planning for your retirement plan moving forward. So let me just quickly explain what a capital gain is. So let's pretend you buy a stock, okay? So you buy a stock at $10 in a non-registered investment account. So outside of your RSP and TFSA or any other registered type account, it's just in a non-registered investment account. You buy a stock for $10 and it goes to $20, okay? So that $10 that you've made is a gain. Now, only half of it is going to be taxed. It's a capital gain. So when you sell it, your $10 gain, $5 of that will be added to your income for taxes and you'll be taxed accordingly, okay? So let's do bigger picture here. Let's say you bought a stock for $100,000 and it went to $200,000 and you sold it. You've made a gain of $100,000, okay? That's your total gain that you're gonna see come into your pocket. Now, 50% of that is taxable, okay? That's the current capital gain structure that we have, okay? So $50,000 would be added to your income in the year of sale, and you'd be taxed accordingly. So if you fell into a high tax bracket of 50%, there would be $25,000 of taxes due, okay? So on your $100,000 of gain, you've only paid $25,000 of tax, okay? That's why capital gains currently in the current structure is a good way to have gains, right? Whether it's through the sale of a rental property or a stock or whatever it is, there's different ways to trigger a capital gain. Now, again, these changes could be happening sooner than we expect. Now, it could happen in the budget, which usually comes out in March or April of 2022. It could actually be triggered before that. We don't know. This is really an unknown, but it could have huge ramifications on your financial plan, retirement plan, and your tax position at death, or maybe your parents or family member at death, okay? So let's go through a couple examples of where these can be triggered. So for a lot of you, you might own a second property. It might be a cottage, it might be a rental property, whatever it is. It's a property outside of your principal residence. Currently, principal residences are tax-free. So any gain that you have on there, when you sell it, it's gonna be tax-free. Again, that's been tabled to also change as well. We're not gonna cover that in this video, but going forward, if you own a rental property, again, a cottage, something like that, anything outside your principal residence, if you sell it, whatever the gain is on that is considered a capital gain, okay? So again, you bought a cottage for $100,000. It's now worth $500,000 and you sell it. The $400,000 is a gain. Only $200 of it would be added to your income. You pay roughly 50% tax at that rate. You lose $100,000, but essentially you end up works out to about a 25% tax rate versus 50% that you would pay on the total thing. So it's a nice way to kind of have a gain, earn some money. It's very tax preferential, okay? Same with a stock. If you bought a stock in a non-registered account or a mutual fund or any type of investment in a non-registered investment account, when you sell that, if there's a gain, it's only taxed at 50%, okay? So those are where most people will fall into, either a property or a stock portfolio. Those are your two main triggers for capital gains. Now, I want to go through some scenarios that you may say, well, I don't own a second property. I don't have a non-registered account, so it doesn't apply to me, okay? Well, the reality is it may not apply to you today, but it might apply to you in the near future, okay? So let's say you're house rich and cash poor, which a lot of Canadians are. Your house has gone up in value. It's your principal residence, so it's tax-free when you sell it. And you have some maybe RSP and TFSA and whatnot built up, but your plan in retirement is to downsize your house, take a bunch of cash and invest it. Well, the reality is you're probably going to invest a lot of that cash into a non-registered account. It's not going to make sense to put a lot of that money into an RSP and your TFSA will be maxed out. So let's assume that you've put $100,000, $200,000, $300,000, $400,000 into a non-registered account in retirement. Now, everything that you make in there going forward as a capital gain is going to be fully taxed, okay? So again, this will affect you. It may not affect you now, but if you plan to downsize in retirement, this could potentially have a big impact on you and your taxes in retirement, and potentially some of the added benefits like OAS, creating an OAS clawback, or maybe a GIS benefit. So again, these small changes, again, you may say they don't affect you now. They may affect you drastically in retirement. Now let's look at a second scenario where it doesn't affect you now, but it could down the road. And this is, a lot of you fall into this that we talk to, and it's, you have maybe your parents or grandparents or someone in your family bought a cottage in the Muskokas or in the Okanagan here in BC, and maybe they bought it for $30,000, $50,000, $60,000, and now it's worth $500,000, maybe even $1 million. There's a huge gain on that, okay? So let's just run through a quick scenario. Let's say someone in your family, let's say your parents, bought a cottage in the Muskokas for $50,000. And today it's worth $1 million, okay? And we hear these stories, like these numbers are not unrealistic, okay? Now, maybe your parents planned ahead and they knew that, hey, this is going up in value, it's had a big jump, and years ago they bought insurance for this, okay? So they knew they wanted to pass that cottage on to their kids, and they knew there'd be a big tax bill. So when your parents die, they're the owners of the cottage, it's going to be a deemed disposition. So at second death between the two of them, it's going to be deemed as disposed, which means that there's going to be taxes due. It's going to be, even though you don't actually sell the property, it's going to be passed to you as a child or you and your siblings, but there's going to be taxes due and your new cost base will be $1 million. Now your parents, because they paid $50,000 and it's worth $1 million currently, that's going to be a capital gain of $950,000. Again, half of that would be tax, and they pay taxes accordingly. So roughly $250,000 of taxes are going to be due. Now, let's say they bought that insurance policy for $250,000 so that, hey, when they pass away, insurance proceeds pay the taxes, you guys can keep the cottage and go on your merry way. It's perfect. It's a great plan. It's a great strategy. But what happens if capital gains changes? Well, the tax bill now goes from $250,000 to $500,000. That whole $950,000 of gain would be included in their income and taxed at over 50% in Ontario, okay? So now they're losing about $500,000 to tax. Where's that extra $250,000 coming from? Your parents may have it in their estate that you can pull out of. Maybe it comes out of your pocket. So regardless of where that comes from, there's an extra $250,000 of tax bill that's going to be due at second death between your parents, okay? Again, this is a very common scenario we see, and we talk to many of you. This could be coming, okay? So there could be a very large tax bill coming and basically double the tax bill that you're currently expecting. Now, another very common scenario that we run into, and we're working through one right now with the client, is they have a large non-registered investment account with a large capital gain, okay? So this client has, let's call it a $600,000 investment in a non-registered portfolio, individually owned, and they have about $150,000 capital gain currently, okay? So the $150,000 currently, if they sold the portfolio, or at least liquidated it, transferred it, did something with it, but they sold the current holdings, which are sitting in mutual funds, they would trigger that $150,000 capital gain, okay? Now, again, half of it's tax, so $75,000 would be added to their income, and they're gonna owe about half that in tax. So let's call it $35,000, $37,000 of tax, okay? It's not too bad, right? It's a 25% tax rate. It's feasible, it's digestible. Now, what happens if on, say, November 1st, the Liberal government comes out and says, hey, we're getting rid of capital gains, 100% inclusion, which means that 100% of your gain is going to be added to your income for the year. Well, now our client has $150,000 of income added this year, not 75. It doubles their tax bill and creates a bit of an issue, okay? Now, this client, as an example, is retiring this year, and in 2022 won't have any income. So in reality, we kind of want to wait till 2022 to trigger that capital gain. We'll pay the tax next year. That'll be their only income. And it's not too bad. They're going to pay, on average about 32% in taxes, okay? So that makes a lot more sense. But of course, if these capital gains rules change, they could change at any time. So if we're going to wait till the new year, we may take a chance that they implement these changes beforehand, and it could be a $35,000 to $40,000 tax bill that is extra beyond what they would have to pay now. So we're kind of looking at this and we're going back and forth to figure out, should they liquidate now? Should they take their chance and do it in 2022? Should we maybe do half now, half later and kind of hedge our bet? These are the things that you need to be thinking about. If you're sitting on a rental property, and we've talked to many of you that have rental properties, and a few of you are starting to liquidate for this reason. You don't know when or if these rules will come into effect. It's an unknown. But if they do, for a lot of you, it could be a huge financial burden and a huge tax hit if these rules are changed. So you're thinking, you know what, real estate's gone up. I think now would be a great time to sell and just cash in and move my assets elsewhere. I totally get that. Personally, that's what I would be doing right now. Again, everyone's situation is a little different, but I think you have to be aware that there's probably changes coming. Because of 2020, the financial burden that was on the country and the debt that the country is currently in, they need to pay off the debt. They need to go after easy money. And at the end of the day, if you think about capital gains, it's kind of easy money. Most people that have a rental property or a non-registered investment account are people that have a bit more money, right? On the investment side, they've maxed out their RSP and TFSA, thus they're using a non-registered account. On the property side, people that have more than just their principal residence, on the most part, have a bit more money than the average Canadian. So for the government to go after the people that are triggering capital gains, it's kind of the low-hanging fruit. So it does make sense. I mean, if you Google it, watch more videos out there, a lot of people truly believe that this is coming and it's coming sooner than later. And it definitely is an easy way to get a lot of tax revenue in on kind of the lowest hanging fruit, like I said. So, we do expect this to come into law or to pass here shortly. Again, whether it comes in next month, sometime in 2022 or beyond, we don't know the timing of it and if it will happen, but you have to start planning your financial picture around this. And what are the tax implications if you wait versus the tax implications if you trigger that capital gain now? Sit down with your financial advisor or your tax professional and figure out what makes the most sense for you. There's also ways you can transfer assets between spouses, trigger the capital gain, but hold on to the asset. It's not that you have to get rid of the cottages and the Muskokas. It's just, you may want to pay the tax now, trigger the capital gain. There's ways to do that. Sit down with your tax accountant to figure that out, to see what the best strategy is for you. But our job on our end, again, we'll always say this, we're financial planners, we're a financial planning firm here at Parallel Wealth. We want to make sure that you're aware of these, right? If you haven't heard of potential capital gains rules changing, hopefully this video opens your eyes to that and some potential tax changes that could drastically impact you. So if you're sitting out there with, either you personally have a rental property or something like that, or a non-registered investment account, maybe your parents have something, or you plan to downsize in retirement, there's a bunch of different scenarios that these rules will impact you and will drastically change the amount of tax you're going to have to pay at some point down the road. So plan ahead, do tax planning, be aware that these changes are most likely coming, because again, it only affects about 10% of Canadians, they figure, but it's going to affect those 10% quite drastically. It's going to be a huge tax bill. If you fall into that, which I know a lot of our viewers do, you need to plan ahead. So hopefully this video helps you out, brings light the situation that's potentially coming. Again, we don't know when, if, all that. It really is an unknown, but it's such a huge financial impact to you that you need to be aware of it and take action. So thanks for joining us in this video. Thanks for bearing with my voice. I just got it back yesterday. Hopefully it'll get better for the next video. But I do appreciate you joining us in all these videos and the continued support. And we'll see you in the next video.